Hey, welcome back. Before we start today's lesson, let's take 30 seconds to recap. Last lesson covered 3 key things. First, the US makes up 60% of global stock market cap. Most other markets are tiny by comparison. Second, the 3 biggest US ETFs each have a personality. VTI covers nearly 4,000 US companies, the most diversified. VOO tracks the S&P 500, the safest pick. QQQ bets on 100 tech-heavy companies, the most aggressive. Third, beginners start with VTI or VOO. Add QQQ later when your stomach gets stronger. Okay, we've covered US ETFs. But here's the question that's probably on your mind. No matter which one you buy, there's the same problem. When the market crashes, what do you actually do? Here's an example. In the 2008 financial crisis, the S&P 500 dropped 38% for the year. That means a $100K portfolio instantly became $62K. And it took nearly 5 years to get back to break even. If you were 60 years old back then, close to retirement, could you really afford to wait 5 years? So today's topic is asset allocation. Welcome to Lesson 8. By the end of today, you'll know how to lock down 2 things at the same time. Returns. And not suffering too much. First, let me define a term. Asset allocation. Asset allocation means spreading your money across different types of assets. For example, stocks, bonds, cash, gold, real estate, and so on. Why do this? Because every asset has a different personality. Some have high returns, but high volatility. Some have low volatility, but average returns. If you only buy one type, you're fully exposed to the risk of that one asset. There's an old saying. Don't put all your eggs in one basket. That's exactly what asset allocation is about. So how do you actually allocate? Let me start with the simplest version, the best fit for beginners. Stocks plus bonds. Just those 2 are enough. Why a stock-bond combo? Because the personalities of these 2 assets complement each other perfectly. When stocks go up, bonds typically stay flat. When stocks crash, bonds sometimes actually go up. Especially government bonds. In other words, when your stock position is bleeding, bonds will cushion the fall. That's the core idea of asset allocation. The drop in one asset gets covered by the rise in another. Let's lay stocks and bonds side by side. 5 differences. First, the nature is different. When you buy stocks, you own a piece of a company. The company makes money, you get a share. It loses money, you lose with it. When you buy bonds, you're lending money to a government or a company. They owe you interest, and they return your principal at maturity. Second, returns are different. Over the past 30 years, US stocks returned about 10% annualized. Bonds about 4 to 5%. Stock returns are roughly twice that of bonds. Third, volatility is different. In any given year, stocks can swing plus or minus 30%. Bonds swing plus or minus 5 to 10%. Bond volatility is only 1/3 of stocks. Fourth, the maximum drawdown is different. The worst stock drawdown was 2008 at minus 38%. The worst bond drawdown was 2022 at minus 15%. Fifth, and the most important, negative correlation. In 2008, when the S&P 500 dropped 38%, long-term US Treasuries went up 26%. One drops 38, the other gains 26. Perfect complement. Putting stocks and bonds together gives you a steadier overall portfolio. One-line summary. Stocks generate returns. Bonds absorb volatility. So in practice, how much should you put in stocks versus bonds? The most famous rule is called 100 minus your age. Whatever your age is, subtract it from 100. The number you get is the percentage you should put in stocks. The rest goes into bonds. Let me give you a few examples. A 25-year-old, 100 minus 25 equals 75. So stocks 75%, bonds 25%. A 35-year-old, 100 minus 35 equals 65. Stocks 65, bonds 35. A 50-year-old, stocks 50, bonds 50. Right down the middle. A 65-year-old, stocks 35, bonds 65. Why is it designed this way? Simple. Young people have time. They can ride out short-term volatility, so they can hold more stocks. People near retirement don't have time to wait for the market to recover, so bonds protect their assets. In recent years, because human lifespan has gotten longer, people often have 20 more years after retirement. Many financial advisors have updated the rule to 110 minus age, or even 120 minus age, to keep more in stocks. Whichever version you use, remember one thing. The older you get, the more bonds you need. Talk is cheap. Let's look at the historical numbers. I'll compare 3 portfolios over the past 30 years. Portfolio 1, 100% stocks. Annualized return about 10.5%. But the maximum drawdown in 2008 was 50%. A $100K portfolio instantly became $50K. Portfolio 2, 60% stocks plus 40% bonds. This is the classic mix, called the 60-40 portfolio. Annualized return 8.5%. Maximum drawdown 27%. Portfolio 3, 100% bonds. Annualized return 4.5%. Maximum drawdown only 15%. Looks like 100% stocks wins on returns. So should you go all in on stocks? Let me show you the actual math. Invest $100,000 and let it sit for 30 years. 100% stocks grows to about $1.9 million. The 60-40 portfolio grows to about $1.1 million. 100% bonds grows to about $370,000. Yes, 100% stocks makes the most. But can you really stomach a 50% drop like 2008 without selling at the bottom? Human nature's biggest weakness is panic selling during a crash. If you'd panic sell after a 50% drop, then 100% stocks is a landmine for you. The 60-40 portfolio cuts your return from 10.5 to 8.5%. But it cuts your maximum drawdown from 50 to 27%. Almost in half. Trading a tiny bit of return for half the suffering. For most people, that's a great deal. So in practice, how do you actually buy bonds? Don't try to buy individual bonds yourself. Too much hassle. Use a bond ETF. Same way you buy a stock ETF. I recommend 3 of them, from beginner to advanced. The first one. BND, full name, Vanguard Total Bond Market ETF. One fund covers the entire US bond market. Over 10,000 individual bonds. Expense ratio 0.03%. Just as cheap as VTI and VOO. This is the beginner's first pick. The second one. TLT, long-term US Treasury bonds. More volatile than BND, but the strongest negative correlation with stocks. Best for hedging your stock position. The third one. AGG. The iShares Core US Aggregate Bond ETF. Almost identical to BND, but issued by BlackRock instead of Vanguard. A solid alternative if your broker has better access to AGG. Let's say you're 25, earning $4,000 a month, and investing $400 a month. 100 minus 25 equals 75. How do you allocate it? Simple. Out of those $400 each month, $300 goes into VOO or VTI. That's 75% stocks. 100 goes into BND. That's 25% bonds. Buy on a fixed schedule each month. Don't watch the market. With this setup, your asset allocation has both a return engine and a shock absorber. The last key concept. Rebalancing. Here's an example. At the start of the year, your allocation is 75% stocks, 25% bonds. A year goes by. Stocks gain 30%. Bonds gain 5%. What's your ratio now? Let me do the math. You started with stocks at 75, bonds at 25. After the gains, stocks become 97. Bonds become 26. Total 123. So stocks are now 79%. Bonds are 21%. The ratio has automatically drifted from your target. Rebalancing means putting it back. You have 2 options. Option 1. Sell some stocks and buy bonds. Bring stocks from 79 back down to 75. Bring bonds from 21 back up to 25. Option 2. Don't sell. Top up with new money. Starting next month, buy more bonds and fewer stocks. Until the ratio returns to 75 to 25. For beginners, I recommend option 2. You won't trigger taxes from selling. How often should you rebalance? Once a year is enough. Or whenever either side drifts more than 5% away from target. Why bother rebalancing? Because this action forces you to sell high and buy low. What's gone up too much, you trim. What's dropped too much, you buy. Over time, your risk level stays exactly within what you can handle. Okay, that's a wrap on Lesson 8, Asset Allocation. Today you learned 6 key things. First, asset allocation means spreading your money across different asset types. The simplest version is stocks plus bonds. Second, stocks generate returns, bonds absorb volatility. Their behaviors complement each other. Third, the simplest rule is 100 minus your age. The older you get, the more bonds you need. Fourth, over the past 30 years, the 60-40 portfolio cut maximum drawdown almost in half, while only sacrificing 2% of annual return. Fifth, beginners use BND to buy bonds. Just as easy as buying a stock ETF. Sixth, rebalance once a year. Force yourself to sell high and buy low. Keep your risk level steady. This week's homework. 3 things. First, calculate your own 100 minus age. Write down how much you should put in stocks and how much in bonds today. Second, open your brokerage app and search BND. See the current price per share. And look up its 5-year chart. Third, honestly write down the maximum drawdown you can handle. If it's 30%, the 60-40 portfolio fits you better. If it's 50%, you can stay with 100% stocks. Next lesson. Lump sum versus dollar cost averaging. If you have $100,000 today, should you invest it all at once, or spread it over 12 months? Which one makes you more money? We'll use 30 years of historical data to give you the answer. And it'll surprise you. Subscribe and hit the bell. See you next week.